Industrials, they're also in the green. There's a lot of green, as you can see on the board today. Takes us to our talk of the tape, this tech takeoff and why some make the argument that it is not done just yet. That is the view of Tom Lee, Fundstrat's co-founder and head of research. He is, as you can see, with us live. Welcome back. It's good to see you again.
Great to see you, Scott.
Doesn't want to let up. It certainly doesn't seem like it wants to. Why do you think it can continue, Tom?
Well, we know bull markets climb a wall of worry, and we know that there's a lot of things that we visibly worry about, including debt ceiling, inflation, the Fed, regional banks. But I think the message that's come out in the last couple of months is companies have been incredibly resilient. You know, they manage costs really carefully. They've been selective in how they manage prices. They've been really good at targeting customers, and I think that's what's paying off. You know, they had a great first quarter earnings season. And as you know, at several of these conferences, they haven't been cutting guidance. In fact, I think they've destocked, so I think there's still upside to earnings. That's one positive story. And the second, of course, is positioning, because people really did rage sell last year, but we know that the bond market is sort of signaling a softer landing than many were expecting. I think that's positive for equities.
So you think there's still going to be a chase to come, at least as it relates to tech, because you've gotten a year's worth of gains in these stocks, and in some cases you've gotten like 5 years worth of gains. It's been quite remarkable, and you know exactly what I'm alluding to. The fact that NVDA and stocks like that up 100% year to date plus, and don't seem to want to let up.
Yeah, I mean, I think what's interesting about NVIDIA is that this was not a widely shorted stock into the results. So that 30% rally was really the market recognizing they have to reprice the future cash flows. I think that's pretty true for most of the FANG trade. You know, one of the reasons we thought it would be our top sector pick this year was that all this wage inflation and need to boost productivity was going to be solved by these FANG companies. And that ultimately translates into better than expected growth. I think that's really the thesis. And it sort of explains why FANG, you know, has really led this year, but I don't find them actually expensive stocks.
Wow. The divergence, though, between, you know, FANG and some of the others and the rest of the market doesn't concern you. I've cited some of the numbers that are out, and you've seen them yourself, I'm sure. Bespoke, the 3-month performance spread between the S&P and the equal weight S&P, the widest it's been since December of '99. We all know what happened in 2000, and the point that is, you know, the intent of this data, Tom, it doesn't make you a little nervous?
It does, Scott, because, you know, market breadth is important to confirm a trend, but I also think it's explainable. I think there are some binary events that naturally would make people cautious, like this debt ceiling. It's hard to say, how do you find equilibrium price today? One thing that we pointed out to our clients this morning was that when you look at industrials and consumer discretionary, there's actually quite a lot of good market breadth, well above the S&P overall, and tech ex-FANG, and even healthcare. So I think groups actually have more performance underneath than is visible. I think a lot of people started too glib saying it's just FANG and nothing else. There's roughly 200 stocks outside of FANG that are outperforming this year. That's actually not bad.
I know, but how long can it truly last if it remains as top heavy as it is, despite the fact that, sure, there may be some other stocks performing, but if you strip out, you know, let's say the 10 biggest names, the rest of the market's up like 4% collectively.
That's right. Our team's been looking pretty carefully at what we call GICS level 2. You know, it's sort of the groups beneath the 10 sectors. And there's a bunch of groups that look like they're about to break out, including the banks. So I think one of the groups to watch is the industrials and the banks, because if they start to react positively to some resolution on the debt ceiling, and we know there's a temporary Fed put helping the regional banks, you know, that's another 40% participation in the equity market. So I think there's a lot of things that could go right, although I'd agree that the breadth hasn't been great.
Yeah, but I mean, this tactical overweight that you have on the KRE, you know, the regional banks, why? Why urge people to take what I think fairly some would suggest would be outsized risk, just given what's happened in the space and the idea that commercial real estate may still have a shoe or two to drop, and it would be felt perhaps most acutely there?
That's right, Scott. It's a tactical bet we're making. There's a lot of conditions that would negate that call, but our take at the time is governments and communities really do value the regional banks. And so the slippage that you lose from deposits not paying market rates is going to diminish. I think loan to value isn't as egregious on commercial real estate as the last 08 cycle. In other words, I think that there can be quite a big impairment on commercial real estate prices and you don't have realized losses. And if that's the case, then these regional banks are going to sort of come back from the low basement valuation. So I think that if that means they can rise 20 or 30% from here, it's still worth a tactical bet because we don't think they're going to zero.
Well, what about the Fed, Tom? I mean, every Fed member seemingly who's come on this network within the last 7 to 10 days suggests it's foolhardy to think that, we may be fully done. Sure, we may pause in June, but don't write future hikes off the table. It's sort of the message that Loretta Mester gave today on this network, and there's been a drumbeat, really, of that.
You're right, Scott. I don't want to fight the Fed in the sense that the Fed is concerned about inflation and they have to talk tough. But at the same time, there are emerging signs coming from the bond market that say that forward-looking data is supporting a Fed that could afford to become a little more dovish. I think today's PCE supports that. We sent out an alert to our clients. I think 3 things within that really told us that future inflation is coming down. One of them being that the 3 biggest contributors to core PCE, more than 2/3 of that rise was housing, financial services, which is because of higher interest rates, and used car prices. I don't think those are really inflationary drivers from the Fed's lens. And we also saw the UMich year ahead inflation come down. Actually, it sort of reversed a lot of that surge last month. So I agree, Scott. I don't want to fight the Fed, but I think the bond market is saying the Fed might be able to stop looking at backwards data and start to look at market-based data.
No, but the bond market, it seems, has come more in alignment with the Fed in recent days. And it feels like you still are fighting the Fed, at least in some respects, even though you suggest you don't want to, because at minimum, it feels like they may not hike anymore, but they're going to remain high for a reasonably, what they suggest would be a long period of time. The effects of that may not fully be known or felt to this point. So aren't you, in effect, fighting the Fed with a target year-end of 47.50? That's a long way to go from the 42.10 that I see right now, by the way, stocks at the highs of the day.
Yeah, Scott, a couple of things. I think NVIDIA tells us what stocks can do that aren't heavily shorted. NVIDIA didn't have a short position, but still did what looks like a sky needle move. I think a Fed staying at 5% for 2 years is tight, but it's not an equity killer because I think the 10-year is still going to see it at 3.5 or 4. That's really since 1930, that's when the highest realized PEs take place, is between a 3.5 and a 5.5% 10-year yield. So I know it sounds like I'm fighting especially 2022 market narratives. But if you look at a 90-year market narrative, 10-year pinned at 3.5 to 5% is actually a 20 PE. And I think it gives us sort of the option value of inflation coming in softer. I think the thing we don't know is there's no tiebreaker yet that inflation's cooling. But I think today's PCE data kind of tells us it could drop sharply over the summer.
I mean, it just feels like it's pretty sticky, if nothing else. And the calls that you've had of late, and let's just say the last few months, that inflation was going to fall much further. It was falling, and it was going to continue to fall much further. May be somewhat suspect by the fact that it looks a little stickier, I think is fair to say, than maybe some had suggested. But let's do this. Let's welcome in Cameron Dawson, CIO at New Edge Wealth, and continue our conversation. It's nice to see you. What do you make of what Tom has suggested?
Well, I think that if we were to get to 47.50, we would be trading at 19.5 times 2024 earnings at $243 a share. That is very expensive by historical standards. And the only times that we've traded up to those levels, if you're looking on a forward basis, not a current year basis, but forward basis, is during bubbles meaning the tech bubble and during the COVID bubble. And the COVID bubble was supported by incredible stimulus to this market, meaning money supply growing 30%, real interest rates negative 1%. And so if we look at where there could be risk, if we trade up to those levels, but you don't have Fed support, you're really in a whole new world of territory where we simply would be trading at unprecedented valuations.
Tom, how do you respond?
Well, as you know, they say a bubble is when your neighbor owns a stock that's making money. And what I mean by that is, I don't think the S&P is that expensive when you exclude FANG. It's trading at roughly 15 times forward earnings. And in fact, the two most expensive sectors outside of FANG are healthcare and utilities and staples. So the question is that if you're worried about valuation, I'd argue there's a valuation bubble in defensive stocks. In the same way that there's a bubble in money market cash balances. Households are sitting on more cash than any time since even the pandemic. In fact, if you look at margin debt as a percentage of the S&P, it's down to 1.4%. That's the internet.com bubble low. There's been a huge deleveraging out of equity. So I think if we let price discover, the stock market is saying that most stocks are at 14, 15 PE. That's not expensive. To get to 47.50 for the rest of the market, that's getting towards a 16 multiple. I don't think that's bubble territory.
I mean, the other part of what Tom has suggested is, even though you've had pretty hawkish Fed speak, is don't so much listen to that, listen to what the bond market is saying. And even though, as I suggested to Tom, the bond market's come a little closer of late to the Fed, that's the place that you should look. Inflation's going to come down faster than people think. The Fed's not going to have to do what it says, and the bond market's forecasting that.
Pricing in the pivot and expecting that to come where the bond market essentially bends the Fed to its will and gets it to price in easier policy has been the widowmaker trade since the beginning of this tightening cycle. And we're seeing it today where now there's over a 60% chance of a hike in June. Just a few weeks ago, that was 0. And so I don't think that the Fed is done, which means that there's still potential for upward pressure on interest rates. And right now we're in this suspension of disbelief where interest rates apparently do not matter for the equity market. We've had periods like this. They haven't necessarily lasted for long. So either the equity market is expensive given the current interest rate backdrop, or interest rates will fall because the bond market is now pricing in a too tight policy path. We think it's likely more the former, where interest rates are reflective of the real reality of this economy.
Because it is pretty remarkable, Tom, isn't it, that the stock market at least has sort of looked the other way. As I'm asking you this question, I said we're at the highs of the day. We're 4210 on the S&P, greater than 340 on the Dow. Interest rates have crept up seemingly almost every day, and the stock market is kind of turning a blind eye to it.
Scott, I actually understand that narrative, and I think it dovetails with someone saying the bond market isn't necessarily saying there's a soft landing, maybe even a hard landing, because if the Fed's serious and we have an inverted curve, that's a hard landing. But when I look at the market, and we know that much of this advance has been driven by FANG, which is solving inflation, I don't want to be sort of throwing out speculation, but one thing we have to keep in mind is that we're already seeing companies slow hiring plans because of the potential benefits from AI and machine learning. That's exactly the dynamic that Volcker was trying to achieve when he was trying to push wage pressures down. So I think there's mechanisms underway that explain why FANG is leading, and the rest of the stock market, therefore, can kind of come into line one direction or the other. If it's a soft landing, there's going to be a huge expansion of market breadth. That's why I think industrials and financials are trying to, even the autos are starting to sort of push above their 200-day and 20-day moving averages, basically enter a bull trend. But yes, we haven't had a tiebreaker moment, but I think that there's too many people in the camp that this is a hard landing, and they're trying to argue that the stock market is irrational. But at the end of the day, the FANG move was actually, it's really a thematic trade that's been built around AI and automation. And you're seeing the numbers from the companies delivered. I mean, NVIDIA shows it. It's not a bubble. It's actually real growth.
I mean, you are kind of one of these people, right, that Tom's referring to. Hard landing, recession probably inevitable, and the stock market valuation now relative to your view is irrational, to use Tom's word.
Well, our call has been that a recession would come later than people expected, and that growth likely will hold up better than expected, and that's what we have seen to begin this year. And I think where we have been wrong, or where we've seen the market move against us, is that we did expect better data, which means tighter Fed, which in the past has meant lower valuations, mostly for growth in tech stocks. And that simply hasn't happened this year. It could just be because of AI and because of the prospect of that E exploding to the upside, pricing in that future potential. It could also be because of liquidity. We know liquidity has been a tailwind because of the spending down of the Treasury cash balance. There has been liquidity added to this market, and that typically is very supportive of growth and tech valuations. And so it's a question on the other side of the debt ceiling, as that liquidity fades, does that become an issue for these valuations?
Tom, have you any sympathy at all for those who suggest that we were saying the same types of things and using the same justifications in 1999 and saying, well, you know, that then it was eyeballs and it was total addressable market, and here we are talking about the potential total addressable market for AI to justify a move that NVIDIA has had this week, or a Marvell, which has had an even greater week than NVIDIA and sort of got lost in the AI shuffle, if you will. But how do you respond to those who say, you know, this is the same kind of stuff I heard in 1999, and we all know how that story ended?
Scott, I think it's a good question to ask. I was a technology analyst in '99, working at JP Morgan, covering a sector that had very high valuations, wireless. That market meant that when I told an analyst, our sales force, I had a buy rating on a stock and the upside was only 20% over the next 12 months, they said, Tom, that's a neutral. Why are you wasting our time? There was a change in market expectations at the time that you could make 20% in stocks in a week. Today, the opposite environment exists. 6 strategists on the sell side changed their price target for the S&P this year. 4 of them were price target raises. Interestingly, 4 of the 6 are still 10% below where the S&P is today. The strategists have become a little more bullish, but they still think we're going to fall off a cliff. I don't think any investor I meet is actually constructive. I was fortunate to meet many investors and companies over the past few weeks, including at the summit, CNBC summit, and I found a huge divergence between how investors think we're already in a recession and companies that are managing through this really well, saying they prepared for a recession last year. They either cut CapEx, cut inventory, or slowed hiring, and that recession's not happening. They have to start going into early cycle mode and expanding because they've really been on a huge strict diet for the last 18 months.
I know you fancy yourself a market historian too, and I know you're well versed on the history of the market. Now, how do you think about that question to Tom, his answer relative to 99 and now?
I think that we're probably earlier innings in this whole part of an upcycle or potential bubble in AI than 1999. Maybe we're a few years before that, meaning that we are seeing the earnings deliver, and you're not at the point where all the tide is lifting any boat that has anything to do with AI, or not even close to AI. So the thing with bubbles to remember is that they can last a lot longer and they can get a lot sillier before they end. But it's always important to remember that on the other side of a bubble, there's typically a crash. So the biggest discipline is to always gut check and say, am I pricing in the entirety of the future growth into today's valuation? And with NVIDIA, it's actually trading at a lower valuation today than it was 2 days ago.
That's exactly right. That's exactly right.
Earnings are
because of the earnings, because of the E.
Yep.
It just reminds me, you know, it was Jim Breyer out at the conference that Tom was at, that we just had our CEO summit, our inaugural one out in California, where he suggested this was 95, that this was the very early days of the internet. And again, we know how it ended. Doesn't mean this is going to be synchronous with that, but we'll see. Tom, thanks so much. That's Tom Lee joining us today. Cameron, yep. Yeah, enjoy the long weekend. And you as well. We'll see you soon. That's Cameron Dawson.